the company posted a net loss of $228.6 million, a sharp increase in year-over-year losses. These numbers are the main reason why the stock is down huge in pre-market trading today. I would say this is fair as the stock has been hyped up by retail traders, while the fundamentals aren't supporting the recent surge in stock price. Now, reality seems to be kicking back in making the stock price drop to more normal levels. The surge in losses was driven by non-cash items, including a $135.8 million derivative liability fair value change. There was also a $70.6 million goodwill impairment charge. Adjusted EBITDA came in at a loss of $8.5 million. This is much wider than the loss of $3.7 million in the same quarter of last year. The company has revised its full-year revenue forecast down to a range between $125 million and $140 million. Previously, it had guided between $160 million and $180 million. Due to uncertainty, especially from disruptions in U.S. Army contracts, BigBear has withdrawn its adjusted EBITDA guidance for the year. Earnings which are being reported below expectations is never good for a company, but to lower the guidance as well on top of that is the worst situation to be in. So what actually caused these weak results? There are a few factors. First, the U.S. Army contracts, which make up a meaningful portion of BigBear's government business, have been experiencing delays. That means less revenue recognized in this quarter. Second, commercial demand for some of their analytics solutions has softened. When the economy slows down, companies often pull back on spending for advanced analytics and AI integration projects, especially if those projects do not show immediate return on investment. Third, the goodwill impairment tells us that previous acquisitions are not performing as expected. If a company buys another business thinking it will generate a certain level of profit, but it fails to deliver, accounting rules require them to mark down its value. That is what happened here. Put together lower revenue, weaker margins, and a big markdown in asset value, you get a report that is not going to make Wall Street happy. Now, to really understand why this stock is hit so hard, we need to remember the context. Over the last several weeks, BigBear had been on a strong rally. From early in the summer until just before earnings, the stock climbed from levels in the mid-$4 range up through $7, and at one point reached a peak close to $9. For traders and short-term investors, those kinds of quick gains are exciting for sure, but they also create an environment where expectations get very high, and when those expectations are not met, the sell-off can be brutal. That is exactly what is happening here, and a good lesson for any investor or trader to always be careful with the capital you deploy. If you have been following my recent videos, you'll know I have been very vocal about avoiding speculative stocks right before earnings. I've said multiple times that even if you believe in the company long-term, the risk of short-term disappointment is just too high. We have seen this exact situation play out before with other high beta stocks. They rally into earnings, the numbers come out weaker than hoped, guidance is trimmed, and suddenly you're staring at a 20 to 30% loss overnight. This is exactly why patience can be so valuable. Sometimes the smartest move is to wait until after earnings are released, assess the reality of the situation, and then decide if the stock is worth buying. In cases like BigBear today, that approach would have saved you from a very painful drop. So where do we go from here? Right now, shares are hovering around the $5 mark. That's a big step down from the $7 range we saw just yesterday, and it's a sharp pullback from the high near $9 in recent weeks. For me, the key is to watch the bigger technical picture. On the weekly chart, the 50-weighted moving average, which often acts as a strong medium-term support level, is sitting around $4.3. Below that, you have the 200 weekly moving average down near $3, which is a much longer-term support line. Those are the two zones I'm watching very closely. Why does this matter? Well, with volatile growth stocks like Big Bear, support levels can give you a better idea of where large buyers might step in. If the price can stabilize at one of those levels, it might indicate the selling pressure is easing and a base is forming. On the flip side, if the stock slices straight through those supports without hesitation, it often means there is more downside ahead. Personally, I would rather let the price come to me at those levels than try to catch the falling knife right now. Now, despite this earnings miss and the sharp sell off, there are still reasons why some investors are keeping Big Bear on their watch lists. One important point is that the company continues to land strategic contracts, and these deals can be a sign that the underlying business still has long term relevance. For example, in late July, Big Bear announced a collaboration with a defense technology company called DAFCON. The goal of this partnership is to develop on demand, advanced modeling, simulation, and integrated data solutions designed to support force readiness and logistics for military operations. That might sound very technical, but in simple terms, it means they're working on technology that can help military planners make faster, better informed decisions during critical missions. This is the type of work that, if successful, can lead to follow on contracts and a stronger foothold in the defense AI sector. It's also an area where competitors cannot just walk in overnight. It takes years of expertise, security clearances, and proven capabilities. So, while the short term numbers look weak, these types of partnerships suggest the company is still building strategic relationships that could pay off down the line. That being said, we have to balance the potential with the risk. These contracts do not immediately offset a large revenue decline or a big drop in earnings guidance. They are promising for the long term, but they do not erase the reality that Big Bear is still a high risk, high volatility stock right now. Looking forward over the next 6 to 12 months, I see two possible paths for Big Bear. In the positive scenario, the US Army contract delays get resolved, some of these new partnerships start generating revenue, and the company is able to stabilize margins. In that case, the stock could rebuild investor confidence and work its way back toward the highs we saw this summer. In the negative scenario, the delays drag on, new contracts take longer to monetize, and cash burn continues at the current pace. That could send the stock back to test the $3 area or even lower. Which one plays out will depend on execution and the speed at which these strategic projects start contributing to revenue. So, is Big Bear a buy now? My answer, not yet. The fundamentals remain weak with falling revenue, widening losses, and reduced guidance. Until the stock moves down to that $4 to $4.3 range and demonstrates support, it remains too risky in my view.